Over the years, Fintech has blossomed and evolved through many significant stages, starting about 20 years ago, and a new era of Fintech is emerging post-pandemic, which is only to be expected with so many rapid changes in the world. While there's no single definitive history of Fintech since it's still being written, it's helpful to think of the original pioneers in the space as Fintech 1.0. These companies varied in size, approach, and ultimately success. What they had in common was offering targeted solutions to specific pain points, like savings, micro-investing, stock trading, peer-to-peer payments, small dollar cash advances, and mobile banking. The Fintech 1.0 companies that blossomed did so by zeroing in on narrow use cases and dominating their own niches. Well-known names like Venmo, which is person-to-person payments, Robinhood, stock trading, and Acorns, savings and micro-investing are all great examples and still flourishing today. Fintech 1.0 led to a situation that still hasn't been resolved completely today, a fractured customer experience that results in too many apps, each specializing in just one area, competing for the user's valuable attention. The pandemic emphasized the importance of Fintech, helping provide access of financial services during the toughest times when people needed them the most, especially in emerging markets. They unbundled banking products and services to provide a more accessible offering to customers, focusing more on being really good at one thing with one primary offering, while providing a seamless and beautiful customer experience. However, the improving economy and broader technical advances enabled banks to build out their products and offerings, shining light on the challenges many startups had with scaling. It was at this point that both banks and fintech companies recognized the synergistic opportunity around partnership, most often with distribution agreements. This is where Fintech 2.0 comes in. So, you may be wondering how Fintech 2.0 is different. The Fintech 2.0 approach centers on what can be called rebundling, which means seamlessly integrating all the things a customer needs to manage their financial life in a single place. If done correctly, combining services that used to be spread over several apps into one, and this should save time, stress, and money for consumers. Whoever can figure out a way to deliver upon this promise will have the leg up in a market that is both huge and ripe for disruption. Working against them is their inability to seamlessly integrate multiple financial products and effectively manage the risks associated with the broad offering of banks and lending products. In order to be successful in Fintech 2.0, organizations will require mastering several aspects of the overall financial experience, all equally important. Firstly, customer-centric thinking. This is perhaps the core of Fintech 2.0 philosophy, not just determining a solution to a single problem point, but recognizing all of a customer's needs and devising ways to meet them holistically. For example, when serving customers who are living paycheck to paycheck, the overall goal is to help people achieve greater financial control, stability, and resilience. Making it easier for customers to fully achieve what's most important to them is what sets Fintech 2.0's rebundling of services apart from what's come before. This requires a deep understanding of and empathy for the customers being served. Second is cutting-edge technology. The best platforms for Fintech 2.0 will be those that effectively leverage data to learn and adapt to a customer's changing needs. In this area, fintechs might have an edge, with the ability to develop more advanced solutions on modern technology stacks. Some banks have been able to close the gap by acquiring startups. However, access to data is important, and legacy banks have tons of it thanks to long-standing relationships with many customers. The key is making good use of it. This means not trapping data in product and channel silos, and not using it to optimize the results of business divisions. Thirdly, sophisticated design. Fintech startups are largely leading the way in this area, coming right out of the gate with a focus on building user-friendly digital experiences. Legacy banks are investing in this area as well, but can be constrained by their traditional business models, which often rely on high fees and prevent them from gaining a holistic view of the customer's relationship. Even the best designed, most intuitive user experience in the world is insufficient if there are high fees involved. Fourthly, bank charters. Legacy banks have used charters as their mode to fend off competition. Fintech 1.0 companies didn't have to worry about obtaining bank charters, as they were laser focused on narrow offerings without a charter. That's changing rapidly, and while true digital banks are rare, they are likely to continue to increase in numbers. As they do, they can serve as testbeds for technology, design and financial product integration, and innovation, with a regulated entity to meet the needs of modern consumers. Lastly, market validation. The markets are already signaling that they are ready for Fintech 2.0, with gains for companies in the space that dwarf even those of big tech. and venture capital increasingly showing a willingness to back neobanks. The building blocks that will go on to establish Fintech 2.0 over the next few years will include, firstly, assets and central bank digital currencies will be used worldwide. There's an ever-growing focus on central bank digital currencies, CBDCs, across the globe. According to the World Economic Forum, more than 40 central banks worldwide are experimenting with blockchain. This means that they will be able to complement currencies in circulation, enable diversified payment formats, and allow for the exchange of tokens in central bank money. Secondly, banking technology stacks will need to be cloud-based to keep up. Banking has the chance to break out of its physical constraints and become more of a persuasive and embedded service. We have entered a world where computing at the edge is as important, if not more important, than the center. Cloud-based systems are the workhorses of big tech, and banks will need to move in this direction to keep pace with the capabilities, efficiencies, and expectations. Therefore, banking technology stacks will become predominantly cloud-based, with significant elements of core processing being open source based. Thirdly, commerce experiences will change with fintech. In the next area, personalized cross-platform digital algorithms, or super agents, will go on to represent 20% of retail commerce transactions. Digital agents will use AI, predictive analysis, web bots, and IoT to determine consumer behaviors, purchasing decisions, and drive action. Lastly, the fintech ecosystem to become a more critical part of the economy. Last but not least, every company will not be a fintech company, but the ecosystem will expand dramatically as it becomes a more critical part of the economy. There has been a systematic shift in the industry, and the next era of fintech is here to stay. It is going to move the needle for the sector in ways we haven't seen before. As companies focus on rebundling and building customer-centric, sustainable, profitable business models where customers, investors, and regulators are satisfied, that's the ultimate win-win-win scenario. It's also an achievable goal for the fintech leaders of the next few years, provided they have a solid grasp on the maturing fintech landscape and the consumer demands that are driving rapid convergence towards Fintech 2.0. What are your thoughts on Fintech 2.0? Let us know in the comments below. If you enjoyed the video, please be sure to hit that like and subscribe button.